With algorithmic trading, a trader is not typically running only one strategy at a time. And yet, in most backtesting tutorials that you see around the internet, it's mostly just exploring a single sample strategy with a specific framework. But this can be unrealistic if you have some interaction between your different strategies, or you just want to get a better idea of how the combined portfolio of strategies reacts to different market regimes. So in this video, I'm going to show some examples in the VectorBT Pro framework that I found useful for simulating portfolios of strategies and seeing how they react. VectorBT is the sponsor of this video, and you can find a link down in the description should you want to check it out. So throughout this video, I'll be using two example strategies. The first one I call top asset rotation, or the TAR strategy. Just a very simple momentum strategy where we take the best performing asset of the last 24 hours, and that's the asset we buy, and then we sell anything else that we hold. Very simple strategy. And then we have the Don-chain breakout, which, as it sounds, is a breakout strategy. And basically the logic of that is that we enter when the close is above the high of the previous 20 bars, and we exit when the price breaks down below the lows of the last 10 bars. We assume that the breakout has finished. So we have two sample strategies that we might be running as part of our wider portfolio, and we're interested to see what the combined results of these two different strategies might be. Maybe you give more weighting to one of them or less weighting to one of them, or we can do something more complex, like we could limit the total number of positions or our total exposure between the two different algorithms that you wouldn't see just simulating them one at a time. Now, the first method I'm going to show here for extracting statistics from this combined portfolio is simply to just do manual analysis. So we have these portfolio objects which are generated by our backtest. This function performs our backtest here, vbt.portfolio.fromSignals. We feed in our trues and falses, which correspond to the pre-computed entry and exit signals. It goes ahead and simulates that with whatever parameters we have here, and it gives us this portfolio object. Now, the portfolio object contains a bunch of stuff. So here we're plotting the portfolio value. It contains this value as a price series. So we have the value at each individual timestamp. And a very simple method of doing things would be to simply pull the returns from both of these separate simulations that have been done. So further up in this notebook, I've gone ahead and calculated the TAR strategy over here as its own portfolio in a separate simulation. And I've done the same thing down here for the Don-chain breakout strategy. So they're two completely separate strategies right now. They don't interact with each other at all. We're just pulling the return series from each portfolio and combining them in some sort of weighted format, so we can join them into a pandas series and then, in this case, average them across the two columns, which will give us the returns that you would get in a 50-50 portfolio. Now, this can be good enough for a lot of different cases. Sometimes you can just pull these statistics out of each separately simulated portfolio object and combine them together to get a combined equity curve like we have here. So this one in the middle is the combined equity curve. And this works so long as your strategies are run genuinely separately. So let's say I have the TAR strategy running on Binance on a bunch of meme coins, and then I have the Don-chain strategy running on interactive brokers trading commodities. So they're completely separate accounts, completely separate accounting and cash management, etc., etc. In that case, something like this would be relatively realistic in terms of establishing the properties of your equity curve that you get out of it and testing under different market regimes. How does it perform in a crash? How does it perform in a blow off top, etc., etc. But this won't be particularly realistic if the strategies interact with each other in some way. So for example, if I limit myself to only having 5 positions across these 2 different strategies, or a certain exposure threshold, these simulations don't account for that because the simulations are done entirely separately. This manual analysis is done completely outside of the VectorBT ecosystem, and so if you're very familiar with pandas, this can be a good option for those strategies that are truly isolated, or you just don't want to simulate that behavior for whatever reason. Now, VectorBT does have an answer here if you want to stay within the VectorBT ecosystem itself with the nice properties of this portfolio object. You know, you can call stats functions on it. It will work in all of your other VectorBT pipelines that consume portfolio objects. And that answer is column stack. So again, we have this Donchain portfolio and the tar portfolio. These are 2 separately simulated strategies. You can read the code up at the top here. And basically, what this column stack function does is it takes all of the internal data structures that are part of this tar portfolio and the Donchain portfolio, and it attempts to combine them. So each portfolio object, for example, will have a list of all the orders that were executed during that simulation. Column stack will attempt to combine these 2 lists of orders together. Similarly with returns, pricing data, etc., etc. It will attempt to stack all of those and combine that into one larger portfolio structure that contains all of that information, and you can call any of your common stats or plotting functions that you're familiar with on the portfolio object itself. In our case, I'm creating these strategy keys and I'm grouping by strategy. So if we look down here, we can see these are 2 separate columns within the portfolio structure. So the individual assets no longer exist. It just has this momentum and breakout because I grouped by those. If you don't want to use the group by, you have to be careful that there are no duplicate columns here. So in our case, we have Bitcoin twice over. In the Donchain strategy, we're trading Bitcoin, and in the tar strategy, we're also trading Bitcoin. So we'd have to be careful to make sure those columns don't overlap. Now, one of the cool things about this column stack function is that we don't require the portfolio objects to be simulated with the same simulation function. So far, for every single one of these, I've used the from signals function. And as you might expect, this takes in a bunch of signals in that data frame format that I showed you earlier with loads of trues and falses. But there are other ways to simulate a backtest. You can do from holding, for example, and that will just test a buy and hold strategy. Or you can do from orders by feeding in a bunch of pre-generated orders. There's a whole bunch of these different simulation functions within VectorBT, but since the column stack is not actually doing the backtest, it's not actually re-simulating anything, we can combine portfolio objects that were generated with different simulation functions. Now, once again, this does mean that there is no actual interaction between these different strategies during the backtesting process. They're done completely separately, and then we combine all of the data about that backtest at the end. So it has all of the same pitfalls that the manual analysis does, except that we can continue to use this within the VectorBT ecosystem. We can also use the apply weights function. So if we grab that portfolio that we generated from the column stack, we can then apply weights to these different strategies and generate a new portfolio object. In this case, I'm applying a 70-30 weighting to the different strategies. And then from that, I can draw this nice graph and compare what an equal weighted portfolio looks like versus a 70-30 weighting. So if you have isolated strategies and you just want a quick way to combine different portfolios together, maybe apply different weightings and extract statistics while keeping it as a VectorBT portfolio object, column stack might be the solution for you, especially if your data is aligned. Now, a third option, which is quite simple but uses a different mental model, is to model each portfolio or each strategy run, which turns into a portfolio object, as a synthetic asset. So what we can do is I can run this simulation here. So I'll run from signals, I'll generate the tar portfolio in a similar way to before. So this does a full backtest using the tar strategy, using the from signals simulation function. I do the same thing with Donchain using its own signals again. And then what I can do is I can pull out the returns from each of these portfolio objects, combine that into a data frame using normal pandas, and then I can treat this as assets to be traded themselves. The mental model here is, imagine you have a portfolio manager running a particular strategy or set of strategies. These are their returns, so this is manager A and manager B, and you can invest your money with each of those managers and take money in and out as you wish. I like this method because it's nice and simple. It would be very easy to have 10 different strategies here and not as much complexity, maybe if the timestamps aren't aligned correctly or if the data doesn't fully overlap. It's a lot easier, in my opinion, to wrangle these returns into a single data frame and then treat that as price data effectively that we're trading. And then we can run a very simple simulation using the portfolio optimizer and from allocate func, which is a separate simulation function like the other ones I mentioned earlier. And all this does fundamentally is allocate equal weights, although of course you could change this function if you wanted to each of these items, each of these theoretical portfolio managers. Each of them gets a half weight in the portfolio, and we rebalance every 10 days. So we can look down at the allocations here, and we see that it, broadly speaking, hugs this 0.5 line. Every now and then, every 10 days, we get a rebalancing, and then if we want to, we can plug the value out of that synthetic portfolio and plot that as the portfolio value here. Now, this approach is very simple and easy to implement, which is why I like it. It does have some downsides in terms of realism. Of course, we have the same issue as before in that the backtests are done completely separately, so the strategies cannot interact with each other. I've said enough about that. We also have this thing where if I allocate, say, 0% to this breakout strategy, that is not quite the same as turning off an algorithm. So it depends on how you manage your strategies. But for example, say if I allocate 0% to this breakout strategy, this breakout strategy simulation has still been done. So it's still following all of the same signals. I'm just not allocating money to it. So it might enter a position, let's say a long position in Bitcoin. Then I decide to allocate money to this strategy. Now we have a bit of a problem in terms of realism, because this strategy is now acting as if it holds some Bitcoin. Whereas if I, in the real world, turned off an algorithm and then turned it back on, I would probably be starting fresh and waiting for more signals to come in, rather than going back through the history looking for entry signals, entering as if I'd been trading the whole time. So basically, the issue with realism here is that you can't actually turn any of these strategies off. But if you're not wanting to do that, then it's reasonably accurate for simulating a portfolio of isolated strategies, similar to just giving portions of your money to different fund managers. Now, all of the examples that I've showed so far here have had this weakness that they all require this limitation, this mental model that all of the separate strategies are indeed separate. They're isolated, like that example I gave earlier with Binance and with Interactive Brokers. They're completely separate accounts. They don't interact. However, realistically, when you're trading, you'll have certain rules or interactions between the different strategies. Like, for example, let's say I have a bunch of momentum strategies running, and I have some breakout strategies, and I have some mean reversion strategies. And let's just say that the mean reversion strategies are in a huge drawdown, way bigger than anything in the backtests. Something has gone horribly wrong. And so I might build in my system that when a specific algorithm or class of algorithms is severely underperforming expectations, maybe I want to stop. Maybe I want to stop trading those. Or maybe I want to double down because I'm expecting mean reversion. But I'm changing the behavior of the simulation across multiple strategies based on what's happening live in the backtest or in the real world. You could, of course, imagine limiting your total exposure across different assets. So maybe I don't want to allocate more than 10% of my portfolio to Bitcoin, even if a bunch of my algorithms tell me that I should be allocating to Bitcoin. If you don't simulate that in an actual backtest, you're not going to have any idea how your strategy actually performs in different environments, because you haven't simulated properly how these extra rules that form part of your meta strategy actually affect the results. So that was a lot of information to say that basically we need to start including these interactions, these portfolio-wide rules into the simulation itself. It can't really be well done retroactively after the backtest is already done by combining the results, which is what we've tried so far. Now, the simplest way to do that within VectorBT is to edit the signals data frame. So if you remember, we had these 3-column wide data frames full of true or false signals for each asset in each strategy. And those are our entry and exit signals, and we had separate ones. This is the Don chain one. We would have a separate one for the TAR strategy. Instead of doing that, what if we merged our signals here into one big data frame and we had a multi-level column structure? This is to prevent two columns having exactly the same reference. So you can have the same asset in multiple different strategies. What if we just combined those into one big data frame? So now we're simulating the whole thing in just one call of this from signals. Now this does force us to use the same simulation function for both of them, so that could be a problem if you want to use different simulation functions. But this does immediately let us have some cool behavior. So for example, we can enable cache sharing here, and now these strategies will fight over the available cache in the portfolio. So I haven't set a position size here, so the default is to go all in. Now meaning that whenever the first signal fires across each of these strategies, the algorithm will go all in on that particular strategy until it exits that position, meaning that none of the others can enter. So this can test your cache management if you just have one pool of capital that each of the algorithms are trading. And you can also apply any filters or rules that you can pre-compute in advance. So for example, I could have a rule that says if I've already entered with the Don chain strategy for a particular asset, so if I've got an entry signal for, say, Bitcoin, don't listen to any of the other entry signals for Bitcoin in any of the other strategies. That could be just one rule, for example. That rule is something that can be pre-computed and applied. It doesn't rely on the simulation state, so it doesn't rely on the current drawdown or what positions we currently have open or how much profit we're currently in. These items can only really be identified during the simulation. If you try and calculate them before simulating, you'll just end up doing a full backtest. So if you have something, some kind of rule that is pre-computable, simply merging everything into one data frame or more generally using a single simulation can be the way to go. But it will only work with these pre-computable items. If you need yet more flexibility, so you need something at runtime. So an example of this could be you want to limit the number of positions that are active at a given time. So I only want 2 positions active, or I only want 20% of my overall portfolio in the market, or I only want 10% into a given asset. All of these things are possible, but we need something that's dynamic, that has access to the actual simulation state. Now, there are multiple ways of doing this in VectorBT Pro, but you want to just look for a simulation function that takes callbacks. So a callback is just a function that we provide as an argument to another function, and that function will be used later on to do some calculations. So I'm still reusing from signals, and I'm still passing my entry and exit signals all exactly the same as before, except I'm using this signal func nb argument, and I'm passing in this function, which I'll show you in a second, along with a bunch of arguments to that function. Now, what this allows us to do is to introspect on our entry and exit signals. As you can see, they're provided as arguments to this function. I provide them here. They get given as arguments to this function, along with this variable c, which is the context. So from this c, which is it's managed by the VectorBT Pro backend, I can pull out of c things like what positions I currently have or what positions I have in the last bar, how much money is available, etc., etc. And so this function will get called on every single cell. So every timestamp, every asset, this function will get called. So you want it to be efficient, hence why they're normally written with number. And then at the end of the function, you want to return something like this. So these are just Boolean flags for long and short entries. And in the in-between here, you can do any sort of arbitrary logic that you want. So in this case, it's a simple example saying that I want to have a maximum position count across these two different strategies. Of course, you could have more. And I want to implement this as a sort of meta strategy. I'm simulating all of my strategies together to get an idea of how the overall portfolio of strategies performs under different environments. So this gives us yet more flexibility in that area by having these callbacks. And there are more of these callbacks that you can use in from signals. And if you want to go deep, there are way more simulation functions that allow more direct access to the internals of VectorBT Pro, such as from orderfunc and its relatives. And of course, you can build yourself a custom simulator if you really, really need it. But for most of you watching, something like this, using signal func with from signals, should be enough to cover a lot of the cases. And I generally like to keep things as simple as possible. So if the manual analysis works for you and that's realistic with the assumptions about things being separate, if that works for you, that's great. And you ascend up this complexity ladder as needed. I wouldn't build a custom simulator for something that can be done here in from signals. So I hope that was helpful in learning some ways of simulating and combining and evaluating multiple strategies within VectorBT Pro, and I'll see you in the next video.